Welcome to the Silent Trading channel. Today I'm going to be analyzing the gold chart on Monday the 9th of March to see whether right now is the trend on the bullish or the bearish side, right? And then we'll also go to see the price action. Is there any price action available right now for us to enter a position? If there is not, then what are we going to do and where are we going to place our buy limits and sell limits, right? So before I start, please subscribe, like, comment and share if you like this video. And to support me in my trading journal, in my guiding you guys using the theory and the strategy that I trade. So I'll start by watching and I'll start by observing the 4-hour time frame first. As you can see on the 4-hour time frame, the chart is still going in a sideways, right? It hasn't created any observable trend yet. Why is it so? Why is the chart not going on a trend yet? As you can see, the lowest bullish price action right now in this sideways zone is at this price point, right, in the 4-hour time frame, and each of the candle that drops down wasn't able to come and attack this bullish price action or this support, right, this key support. But the latest candle, the latest daily candle, or the first 4-hour candle of the day, push up to create push up, right? Push up producing a top wick before pulling back and then pushing down all the way to even attack this support. And after attacking this support, push down further to create a new low before pulling back, right? Pulling back and then closing. This closing shows us that the 4-hour time frame hasn't shown any price action that is trying to break support, which means the chart isn't showing any bearish price action yet and pushing up, right? Before it pushed down, right? The last week it tries to push up but wasn't able to break resistance yet, so thus not producing any bearish or bullish price action, right? So resistance is not broken, support is also not broken, which means right now the chart is still in a sideways. And in a sideways means that to enter a position right now in this sideways frame or this triangular sideways frame, it is still too risky. Because why? If you're looking to open a position, if you're looking to enter a trade, you ought to enter that trade when the price pushes all the way down, right? When the price pushes all the way down while not touching the next support. The next key support is where? The next key support that is in this chart right now is the 5,000 key support and also the weekly support, which means when the price goes all the way down by not touching this weekly support and this 5,000 psychological support, which is also a key support, this is a place that you ought to buy or you ought to enter a trade. But if you miss out this price point in entering a trade, there is no more possible point right now in the chart to enter a trade. Because why? Because you can be sure that right now price action isn't decided yet, right? And I've always told you guys that we will only enter at breakout. If it is breaking out above, we're going to be selling and waiting for the price to mitigate this gap, right? Or wait for the price to retrace and taking out buy side volume, and then we can close our sell position. Or if the price breaks below, we are only looking to buy, right? We're only looking to buy and then wait for the price to retrace and clear off sell side volume. So why is it that I need to buy or sell at breakout? Why is it? I think I have explained multiple times that buying and selling at breakout is one of the best possible way to enter a trade, but it is also risky as can be. Because why? Because let's say if this at this price point right now, if the chart is breaking below, right? So let's say if the chart is breaking below right now, right? Attack support, push past weak, create a new low, right? Attack. Let's say it doesn't attack this support anymore. It goes down all the way to attack this support, right? So when a price attacks support, why is it that in my belief that when price attacks support or the market attacks support, when a candle comes to attack support, why is it in my belief that when it attacks support, it ought to go down further? Because there will always be buy limits from retail traders placed at multiple support, and sell limits placed at multiple resistance, which means support and resistance is the place or is the spot that the market is looking to start accumulate buy side volume if it is support, and the market is looking to accumulate sell side volume if it is resistance, which means when the price goes up to touch resistance, there will be sellers looking to enter a trade at resistance, right? Or if they are not on the chart, if they're not looking at a chart, there will also be traders placing sell limits at resistance. So when price goes up to touch resistance, goes up to attack resistance, the price ought to break out further, because why? This breakout further is to take out stop loss that those holding a sell position place, which means if the stop loss is a few hundred pips or 1,000 pips above resistance, price ought to push up, right? Push up, attack resistance, and then push up further. Only after taking out stop loss can the price retrace to take out buyers, right? And after taking out buyers, can the price goes up further, which means when the chart breaks above, there is one chance of entering a position that goes against the trend. Because why? When it goes when it push up, when it breaks above, there is a chance of the market or the candle retracing, and we close this position that is against the trend when the chart is retracing, and we close it, right? And then we play according to the trend when the chart retraces, and then we start buying. But when it breaks above, we can enter a sell position. But always be aware that this sell position over here is going against the trend, and it's quite risky. So the best possible ways to enter a trade is to wait for the chart to retrace after breaking resistance and then buying at this spot. But if not, if you're confident that you can manage your portfolio well, when the chart breaks above, you're going to be entering one sell position, and once the chart retraces, you're going to be closing that sell position no matter how much profit you're getting, right? Even though you think it's not enough, you need to be closing it, because retracement is meant for the price to push up further, right? So why is the price retracing? It is retracing to take out buyer's stop loss, right? Like the same way when it breaks above, it is looking to take out seller's stop loss. So when it retraces, it is also taking out buyer's stop loss, because why? When it retraces, it always comes down to support, and when the price comes down to support, it is accumulating buy side volumes also. So when the chart is also accumulating buy side volume, it will then push down further to take out those buy side volume or taking out those buyers before the price start going up again, right? So that is the first and foremost reason why we always enter at breakout, because a breakout or a sharp expansion is where price will most likely goes into the opposite direction to clear, right? So if the price is breaking out below, right? So if the price is going to break up below, attacking support means accumulating buy side volume, and once the chart accumulate buy side volume, the chart will have to go down further, which means more break below, right? Which means more expansion below. So when the price accumulate buyers at support, the price is going to break below further, and then we start buying, right? Why is it that we buy below instead of buying at support? Because we know that support is where retail traders are placing a buy limit, so we wait for those retail traders to be taken out before we start buying, which means at least our buy position or our buy limits should be lower than the place that retail traders are looking to buy, right? So once the price push down, retail traders are taken out, buy side volumes are taken out, and we start buying at below where those buy side volume are taken out, and then when the price start retracing, it is where we're going to be closing a position. So after closing a position, when price retrace, if the price is pushing down again, we will not have any orders or position on our portfolio, because we have closed our portfolio, we have taken profit, and we understand that the price is retracing to push down further. So we will not be holding to that position for too long, right? Because we will always be checking the price action, we'll always be checking the chart movement. And when we open with a chart movement checking, right? We check the chart movement before we open the position, and then we close after we check the chart and see that there are price action that shows us that the chart is really going to come back down. So our buy position should have been closed when the chart retraced to take out sellers. Because why? Every time when the chart expands, right, there will be buyers waiting at support, right? And every time buyers are waiting at support, and after buyers are taken out, there will also be sellers in the chart. Because why? When price goes down too much, there will always be people panic selling, and those panic selling orders will always be at below. And after sellers are leave at below, the market ought to reverse, right? Reverse from here, and then leave those sellers below in a drawdown, and the market push up. And why is it pushing up? It is pushing up to take out sellers stop loss, and those trading without stop loss, the market is pressuring them into closing a position, and only after those sellers close their position can the market push down further. But if the sellers are not closing their position, the next thing the market is going to do is the market is going to complete this bullish reversal and then retrace, and after retracing, the market is going to push up further. It will keep pushing up until sellers are out of the market, and then buyers start coming in. And when buyers start coming in once again, the market is going to create a bearish price action and then start going down, right? So by now you should know that the market doesn't always follow the price action, because sometimes even though the price action is bullish, but if there are too many buyers on the market right now, the market will dump, right? So like, let's say if the market right now is bearish, instead of dumping, if there are too many sellers right now, the market will push up, the market will expand upward. Why is it so? It is doing this also to pressure and force retail traders into closing a position before they will go on the initial trend. So by understanding this, you will know that the market, though it follows price action, it doesn't always follow, because it is also trading according to human psychology, which means if most traders are buying, the market is going to drop. If most traders are selling, the market is going to climb up, right? So beware, always be careful in trading. Try to understand what the market is trying to do. If the market is taking out buyers, wait to buy at the below price, at below those buyers price. If the market is looking to take out sellers before pushing down again, then wait to enter a position after those sellers are taken out. Okay, so for today, that is all I'm going to be analyzing, and I'll look forward to be analyzing with you guys tomorrow. So stay tuned to my videos tomorrow, and for today, I'll see you guys and see ya.